stop scrolling. If you're a silver stacker and you just watched price drop 7% in a couple of hours, I need you to hear this before you do anything stupid like rage sell your position or swear off the metal forever. Because what you just saw wasn't the market being the market. It wasn't silver suddenly becoming worthless, and it definitely wasn't a clean, honest price discovery moment. What you just watched was a mechanical mugging, a planned, legal daylight hit, executed with paper contracts, timed flows, and one perfect cover story, the annual index rebalancing. And the punchline? The same whales who dump the price are usually the ones buying the bottom from the panic they created. Now, quick disclaimer before we go any further. This video is for education and entertainment, not financial advice. I'm not telling you what to buy or sell. I'm explaining the plumbing so you can stop being the person who supplies liquidity to predators. 3 hours ago, the room looked normal. Silver was moving like a strong market. Bids, asks, steady flow. Then, bang, price starts dropping like someone pulled the floor out from under it. Candles go vertical, but down. Spreads widen. The tape starts printing lower and lower. You see it and your stomach does that cold water thing. So what happened? The simple headline everyone throws at you is rebalancing. Rebalancing sounds boring. It sounds like accountants in cardigans. It sounds like passive funds quietly adjusting weights with minimal market impact. That's the fairy tale. The real version is this. Rebalancing week creates predictable, scheduled, institution-sized flows. And predictable flows are a gift to whales, because whales don't need to guess when liquidity will show up. They know when it's supposed to show up, so they use that scheduled liquidity window like a mask. Think of it like a parade. The police are busy watching the parade route, and the thieves choose that exact moment to hit a jewelry store 2 streets away because the chaos looks normal. That's what index rebalancing is, the parade, and the dump was the robbery. Why this always happens fast. If you've never watched a futures market get hit with size, it feels unreal, like, how can a market worth hundreds of billions move this hard, this quickly? Because futures don't trade like a farmer selling corn. They trade like a high-speed risk engine. A futures contract is a promise, not a bar. It's a leveraged bet that can be opened, flipped, and closed in seconds. And because the leverage is high, the players are hypersensitive to short-term volatility. Their models don't ask, is silver scarce in 2026? Their models ask, is my VAR exploding right now? So when a whale smashes the book, everyone else, dealers, hedgers, prop desks, HFT, reacts instantly to protect their own balance sheet. And that reaction is why the move looks like a waterfall. It's not that everyone decided silver is trash. It's that everyone decided, for 90 minutes, to not be the one caught holding risk while the floor is moving. That's the first illusion you need to break. What does 7 billion even mean? Let's talk numbers, because 7 billion can sound like monopoly money until you translate it into market mechanics. In the futures market, you can control an enormous amount of metal with a relatively small amount of margin. You don't need to own $7 billion of physical bars. You need enough collateral to swing paper exposure. That's why a futures dump can hit price fast even if the physical world didn't change in those same minutes. So picture this. A whale, or a cluster of whales, decides to sell a massive block of silver futures. Not gradually, not over the day, not with a VBWAP algorithm that tries to be gentle, all at once. They hit bids like a battering ram. And here's the trick. When a giant sell order slams into the order book, it doesn't just move the price. It changes the behavior of everyone else in the market. Market makers back away. Algorithmic liquidity providers widen spreads. Stops get triggered. Momentum systems flip from buy the breakout to sell the breakdown. The selling creates more selling. It's not a normal chain reaction. It's engineered. Translating the dump into contracts. Let's make it concrete with rough math, just so your brain stops treating this like a mystery movie. A standard silver futures contract is 5,000 troy ounces. If silver is, say, in the high 80s or low 90s, each contract represents hundreds of thousands of dollars of notional exposure. Now imagine a whale wants to show $7 billion of sell pressure. They don't need $7 billion in cash. They need the ability to post margin and tolerate short-term heat. So instead of thinking 7 billion bars, think tens of thousands of contracts hitting bids. And here's the tell. When you see a move that looks like a cliff, it's usually not one retail crowd panicking. Retail doesn't have the firepower to punch through multiple layers at once. A cliff is created by concentrated size interacting with a thin moment in the book. That's why we call it a dump, not a drift. The liquidity vacuum, how prices fall through air. The alleyway analogy, how a mugging works. Let me tell it like a street story, because it's the same psychology, just cleaner shoes. You're walking with your wallet out. That's retail. Visible, predictable, emotional. The mugger doesn't jump you when the street is crowded with cameras and witnesses. He waits for the alley, the quiet stretch, the moment you're distracted. In markets, the alley is any window where liquidity is thinner than normal or where flows are predictable enough to be exploited. Rebalancing windows can be that alley, so can late-day sessions, so can holidays, so can minutes, right after a big economic release, when the book is being rewritten. The mugger's move is simple. Shock you. Make you drop the wallet. Pick it up calmly. In futures terms, slam the bids. Trigger stops and margin calls so weak holders puke positions. Buy back into the forced selling. That's the entire blueprint. This is the key phrase you need burned into your brain. Liquidity vacuum. A market doesn't move on value, it moves on liquidity. Liquidity is simply how many real bids are sitting there, ready to buy, right now, without disappearing. In a healthy tape, there are layers of bids. You can sell into them and the market absorbs it. Price may dip, but it doesn't free fall. But when whales dump into a predictable window, like rebalancing, they can create a shock so large that the bids vanish. The book goes thin, the next real bid might be 30 cents lower, then another 40 cents lower. So the price doesn't walk down the stairs, it falls down an elevator shaft. That's the vacuum. That's why it didn't exist 3 hours ago, and that's why it feels like someone turned gravity up. Now here's where retail gets trapped. You're watching the chart, you're watching your P&L, you're seeing the headlines start to pop up. Silver crashes. Safe haven gets smoked. Speculators flee. And you do what most humans do under stress. You try to stop the pain. So you sell, or you close, or you throw your hands up and say, I'll buy back when it's calm. But calm is not what the whale is waiting for. The whale is waiting for forced selling. The machine reaction, why algorithms make it worse. Here's something most people miss. The first wave is human designed, but the second wave is machine amplified. A whale hits the book. That's the spark. Then the machines wake up. Momentum algos. Price is falling fast. Sell. Trend systems. We broke support, reduce exposure, market makers, spreads widen, inventory risk increases, quote smaller. Options dealers, delta is changing, hedge by selling futures. All of that happens with no emotion, just rules. So the dump is like knocking over the first domino, and the machine layer is a room full of pre-stacked dominoes. That's why these moves feel unfair, because they are asymmetrical. One big player can trigger a chain reaction that forces many small players to act the same way. And once the chain reaction starts, news outlets will report it as if it's a democratic vote. The market sold off. No, the market got shoved. The three triggers they count on. A mechanical hit like this doesn't rely on one thing. It relies on a sequence. And the sequence usually has three triggers. Trigger number 1. Stops. Retail traders, and even some smaller funds, put stop losses under obvious levels. The moment the whale punches price through that level, those stops turn into market sells. That's gasoline. Trigger number 2. Margin pressure. Futures are leveraged. When price drops fast, the broker doesn't care about your long-term thesis. They care about risk right now. If you're under-margined, you get the call. If you can't meet it, your position gets liquidated at market into the drop. That's rocket fuel. Trigger number 3. Narrative shock. Humans need a story, so social media and financial media supply one instantly. Silver is broken. Demand is collapsing. Recession fears. Whatever. The story doesn't need to be true. It needs to be plausible enough to make panic feel justified. Those three triggers create a stampede. And stampedes are exactly where whales shop. The forensic timeline. How it looks from above. Let's zoom out and watch it like a surveillance camera. Minute 0:10. The first heavy sell waves appear. Price starts slipping. People think it's a normal pullback. Minute 10:25. A key level breaks, stops trigger, volume spikes. The tape looks busy, but it's one directional. Minute 25:45, spreads widen, liquidity providers step back. The order book thins. You start seeing gapping, prints with air between them. Minute 45:70, margin calls begin to bite. Forced liquidations hit the market at the worst time. Social media fills with panic screenshots. Minute 70:95. The selling slows, not because fear ended, but because there are fewer sellers left who can sell. The weak hands already dumped. Minute 95 to 120, a stabilization zone forms. You'll often see a violent bounce attempt. Shorts cover, smart money tests the bottom. Minute 120 plus. The narrative catches up. Headlines appear after the move is mostly over. Retail feels like it reacted late. Because it did. That's the mugging pattern. And if you've lived through a few of these, you start to recognize that the bottom is not a magical price. It's the moment the forced sellers run out of ammo. 9:10. Index rebalancing 101 without the tedious part. Okay, so what is annual index rebalancing in plain English? Big pools of money track rules. Not opinions, rules. commodity indices, multi-asset indices, risk parity baskets. They're basically gigantic autopilots, and once a year, sometimes quarterly, those autopilots adjust the weights of what they hold so the portfolio matches the index's formula. If silver had outperformed, its weight might be too big, so the rules require trimming. If something else underperformed, the rules require adding. No emotion, no thesis. Just the math says rebalance. Here's the part whales love. The timing is predictable. Funds often execute near the close or over a tight window to minimize tracking error. That concentrates flow. Flow concentration creates fragility. The direction can be estimated. You don't need the exact number. You just need to know whether the basket is likely a net seller or buyer of silver futures. The execution is passive. Passive flows don't fight back. They don't defend levels. They just follow the schedule. So imagine you're a whale and you know a wave of passive selling is coming, or at least that the market expects big two-way flow. You can hide your own aggressive selling inside that wave like a shark swimming under a school of fish. On the tape, it's hard to prove which contracts were rebalancing and which were predatory. The public story becomes, oh, rebalancing caused volatility. And technically that's true. But it's like saying, the crowd caused the pickpocketing. The crowd didn't pick your pocket. The crowd just made it easier. That's why this is so frustrating. The cover story is real, but it's also useful camouflage for bigger, sharper players. Why rebalancing is the perfect alibi. Here's the genius of using rebalancing as cover, it's expected volatility. If you dump size in a random week, people ask questions. Regulators get curious. Other institutions front-run you. The tape looks off. But during rebalancing, big flows are normal. People shrug. Commentators say, oh, that's the index. So whales can shove an aircraft carrier through a canal, and everyone acts like it's just another boat. Also, rebalancing gives you something else, a predictable time window where passive and systematic funds are active. That means the whales can model where liquidity will appear, where the market is most fragile, and where the stops are clustered. It's like having the building blueprints before you break in. Now, am I saying there's a single villain in a top hat twirling a mustache? No. This is worse. It's a system where incentives reward predatory timing. Nobody has to conspire. They just have to do what works. But why would they sell if they want to buy? This question is so important. Because a whale isn't thinking like you. You think, if I like silver, I buy and hold. A whale thinks, I want exposure, but I want it cheaper, and I want everyone else to pay the slippage. If you can push price down with paper, you can. Harvest stop liquidity, shake out leveraged longs, reset funding and positioning, force hedgers to adjust, create a better entry for your own long book. In other words, you use selling as a tool to manufacture the conditions for buying. It's cynical, but it's how big money behaves in any market where leverage exists, and silver is loaded with leverage. The buyback, how they get paid twice. Let's talk about the part that makes stackers feel sick, the buyback. When the dump is done and the vacuum has done its work, price stabilizes, usually at a level that looks ridiculous compared to an hour ago. That's when whales flip. They start buying back the same contracts they just sold, not at the original price, at the bottom, so they profit on the way down and then they reload cheaper. Meanwhile, retail is doing the opposite, selling low after holding through the top. That's why I call it a mugging, because your money didn't evaporate, it transferred from weak hands to strong hands. And the strongest hands in the room are not emotional, they're systematic, they're capitalized, they have time. How the bottom gets built. Here's another thing retail rarely sees. Bottoms are often constructed, not discovered. After the flush, whales don't usually smash the buy button in one heroic green candle. That would move price against them. Instead, they work the bottom. They use smaller iceberg-style orders, lots of small buys that add up. They let the market bounce a little, then they fade it to keep it contained. They wait for the worst headlines to hit because headlines bring the last wave of retail selling. Sometimes you'll even see the most insulting thing. Price starts rising before the news turns negative. That's because news is late. It's a rearview mirror. So the whale's buyback phase often looks like messy, sideways, exhausting. It's designed to bore you. It's designed to make you think, see, it's not coming back. And then, when enough sellers are exhausted and enough shorts are trapped, the market rips higher with the same violence you just saw on the way down. That's why this stuff feels like a psychological experiment. Because it is. Paper vs. physical. Why your coin shop doesn't care about today's candle. Stackers live in a weird split reality. On your screen, silver is a number that can drop 7% in a lunch break. In the physical world, silver is a product with fabrication costs, shipping constraints, and dealer risk. That's why physical premiums can be sticky. A dealer doesn't instantly reprice every round and bar the moment futures wick down. They have inventory bought at different costs, they have hedges, they have customers who don't trade on 5-minute candles. So one of the most revealing tells is this. If futures crash, but physical availability doesn't suddenly flood the market, the crash is mostly paper. Now, that doesn't mean you ignore paper. Paper still sets the base price. It means you don't let paper volatility rewrite your story about real metal. And it means the whales can't conjure extra mined supply in 3 hours. They can only conjure fear. But doesn't this mean silver is dead? No. And this is where stackers need to separate the screen from the substance. Ask yourself a brutally simple question. Did anything about industrial demand change in the last 3 hours? Did solar installations suddenly stop? Did EV production get canceled? Did data centers stop being built? Did electronics companies discover a new conductor better than silver? No. The physical world doesn't move that fast. The paper market does. Paper can be used like a weapon because it's scalable, it's leveraged, and it's fast. Physical is slower, stickier, and constrained by real supply chains. That's why you see these violent paper flushes even when the physical market is tight. So if your thesis for owning silver is long-term scarcity meets industrial necessity, a 2-hour paper hit doesn't rewrite the thesis, but it can absolutely shake you out of the position if you don't understand the game. The 5 red flags that scream mechanical event. If you want a cheat sheet, here it is. Red flag 1. The move happens into a known calendar window. Rebalance, expiry, thin session, scheduled event, anything with a clock attached. Red flag 2. The selling is too clean. It's not messy human panic. It's persistent, relentless, like a machine pouring sand. Red flag 3. The bounce attempts are instantly swatted. That often means someone is feeding sell orders into rallies, controlling the tape. Red flag 4. Correlated assets don't confirm. If silver collapses but other linked markets aren't moving in the same fundamental direction, that's a clue. Red flag 5. After the flush, the market suddenly becomes normal again. Spreads tighten, volume normalizes. It's like the storm turned off. Fundamentals don't turn off like a light switch. Execution does. How to read a paper, mugging like a detective. Let me give you a mental checklist, not advice, a checklist, so you can tell the difference between real fundamental collapse and mechanical hit. Speed. Fundamentals don't usually move in straight lines in minutes. Mechanical events do. Volume clusters. If you see huge volume spikes at specific times, like a bell ringing, that's often scheduled flow or coordinated execution. Spread behavior. In a vacuum, spreads widen and the market feels slippery. That's the order book thinning out. Snapback attempts. After the flush, you'll often see sharp rebounds as liquidity returns and shorts cover. Physical premium behavior. This one matters for stackers. If spot drops but retail premiums don't collapse the same way, or they even rise, that's a hint the physical market isn't matching the paper panic. Again, not telling you what to do. I'm telling you where to look. The 2 big retail mistakes that turn you into prey. Let's be blunt. Mistake 1. Treating leverage like confidence. Leverage feels like conviction, but it's actually fragility. It puts a clock on your thesis. The whale doesn't need to prove you wrong long term. They just need to shove you out short term. Mistake 2. Buying with no what if. If your entire plan is up only, then the first real drawdown will emotionally own you. A plan needs an if then. If it drops, what do I do? If it rises, what do I do? If it chops for months, what do I do? Most people skip that because it's boring. And then the market makes them learn it the hard way. Why retail panics right into their hands. This part is psychological, and it's the part nobody wants to admit. Most retail doesn't have a plan. They have a vibe. They bought because it felt smart at 90 toes, then it drops to $86, and suddenly they think they're idiots. But the metal didn't change. The plan did, or rather, the absence of a plan got exposed. Whales don't need you to be wrong about silver. They just need you to be wrong about your own risk tolerance. They need you to oversize at the top. They need you to use leverage you don't understand. They need you to anchor to a price instead of a process. And when the vacuum hits, they need you to react. That's the whole business model, harvesting reactions. The one breathing rule during a hit. If you take nothing else from this video, take this. Never make a decision in the first 10 minutes of a panic move. Your body is in fight or flight. Your brain is trying to end discomfort, not solve a problem. That's why the first impulse is almost always the wrong one. Step away from the chart. Drink water. Write down what you believed yesterday, then come back and ask, did the real-world supply story change? Or did the paper tape just get weaponized? That pause is expensive for predators because predators feed on speed. What I'd watch next, educational, not a prediction. Okay, if you want to stay grounded after a mugging, you watch signals that can't be faked as easily as a headline. You watch positioning, open interest, and how it changes after the flush. You watch whether the rebound is met with new selling or whether sellers are exhausted. You watch volatility. Does it stay elevated or does it collapse back down? You watch the physical side, dealer premiums, delivery times, and whether product vanishes on dips. You also watch sentiment. When everyone online is screaming silver is a scam, that's usually closer to a bottom than when everyone is posting rocket emojis. Again, none of this is a guarantee. It's just how you avoid being hypnotized by one candle. The cleanest way to think about this drop. Here's the cleanest way to frame the last 3 hours. This was not silver being repriced by the world. This was liquidity being repriced by the machines. The whales used a calendar event, index rebalancing, as camouflage to unload size. That size punched through the book, triggered stops, forced liquidations, and created a vacuum. Then, with everyone else coughing up positions, they buy back cheaper. And because it's wrapped in the language of rebalancing, it gets normalized. People say, that's just how it goes. No, that's just how it goes, if you don't see it. The real villain, not the whale, the game. I'll say something that might surprise you. The whale isn't the root problem. The root problem is a market structure where leverage plus predictable flows plus automated execution creates a hunting ground. In a structure like that, predators emerge naturally. It's like leaving food out in the open and then acting shocked when animals show up. So the point of this video is not to whine, it's to educate. Because once you see the structure, you stop personalizing the move. You stop treating a dip like a betrayal. You treat it like weather in an arena designed for storms. And you build your behavior around reality, not around hope. What stackers can take from this without coping. Let's end with something practical, because doom doesn't help you. If you're a stacker, meaning you care about the physical metal, the paper market is still the screen that sets your price. You can't ignore it, but you also don't have to worship it. Paper volatility is the ocean surface. Physical supply and demand is the current underneath. When the surface gets whipped into a storm, you don't conclude the ocean disappeared. You conclude the wind changed. So the real lesson isn't silver is dangerous. The lesson is the paper market has traps, and the traps are timed. Index rebalancing, options expiry, thin holiday sessions, Fed days, big CPI prints. Anytime the calendar concentrates flows, the whales sharpen their knives. If you understand that, you stop taking every dip personally. You stop treating every red candle like a moral verdict. And you start thinking in processes, not emotions. If this drop made you furious, good. Use that emotion the right way, not to sell in panic, but to learn the rules of the arena. Because the whales don't fear your conviction. They fear your competence. If you want more breakdowns like this, how the paper market games the physical story, hit subscribe, because the next leg of this move is going to be violent in both directions. And in the comments, tell me one thing. When silver dropped today, what did you feel first? Anger, fear, or excitement? Say it out loud. That's how you stop the mugging. One last thing. If you got shaken today, you're not weak. You're human. Learn the pattern, tighten your plan, and next time you'll watch the hit like a pro. No shame. Just reps. Again.